All right, let's talk about your pension. If you're getting one now or you're about to, there is a very good chance, I'm talking a 71% chance, that you're overpaying the IRS. Today, we are going to dive into 5 solid strategies to help you cut that tax bill way down and keep more of your hard-earned money right where it belongs, with you.
Take a look at this number, $4,200. That is how much the average retiree unnecessarily pays in extra federal taxes on their pension. And that's not a one-time thing, that's every single year. Over a decade, that's more than 40 grand that could have been in your pocket. And this right here, this really puts it all into perspective, doesn't it? Just look at that huge bar. Nearly 3/4 of people with pensions are just leaving money on the table. Why? Simply because they aren't using the right game plan. Our goal today is to get you firmly into that smaller, much smarter group. So why is this even such a big issue? Well, it all starts with understanding something really important about how your pension gets taxed. And trust me, it's very different from your other retirement income. This slide really highlights the critical difference. You see, with Social Security, a chunk of it might be completely tax-free. But your pension? Most of the time, the whole thing, 100% of it, is taxable as ordinary income. That means it gets taxed at your highest rate. The main takeaway here is that every single dollar from your pension is a prime target for taxes. But here's the good news, you can absolutely fight back. So let's get into the good stuff, the 5 proven strategies that can completely change your tax picture for the better. Okay, strategy number 1 is the most fundamental of them all. It's about using the tax code's built-in shield, the standard deduction. Think of it as a set amount of your income that's automatically tax-free. So, the goal is simple. We want to keep as much of your pension income tucked away under this tax-free umbrella as possible. Let's look at Janet's story. It's a perfect example. All she did was delay taking her Social Security benefits for a few years. That simple move lowered her total income for a bit, which let her standard deduction cover way more of her pension. And the result? Just look at that. She cut her yearly tax bill by almost half. That's over $2,000 in her pocket, year after year. All right, now for what is honestly the biggest win of them all, choosing where you live. And this is not just about the weather or being close to the grandkids. It's a massive financial decision. Moving to a tax-friendly state before your pension kicks in can be a total game changer. We're talking potentially 6 figures in savings over your retirement.
So let's imagine a guy named Michael. He was planning to retire in California. Well, this was his estimated state tax bill on his pension alone. Almost $7,000. Gone. Every single year. And when you zoom out and look at that over a 25-year retirement, wow, the total cost is just staggering. Over $167,000, all paid in state taxes. But what if Michael got smart? By setting up his residency in a no-tax state like Nevada, before he started taking that pension, his annual state tax bill plummeted to 0, a big fat 0. He gets to keep that entire $167,000. You see, timing here is absolutely everything.
And that brings us perfectly to our next critical timing strategy, optimizing your pension start date. Most people just start taking it the day they retire. But the real key is to start those payments in a year when your other income is low. That way, you totally minimize the tax hit right from the get-go.
Robert's choice is the perfect illustration. By waiting just 3 years until he was done with his part-time job, he not only got a $9,000 a year bigger pension for the rest of his life, but his tax bill on that larger pension was less than half of what it would have been. More money, less tax. It's a no-brainer.
Okay, this next one is a fantastic strategy for anyone who's over age 70 and a half and is charitably inclined. It's called a qualified charitable distribution, or QCD. Basically, it lets you donate money directly from your IRA to a charity. And the magic is that money never shows up as taxable income to you. It's like it was never there.
Look at how this played out for Patricia. She was going to donate $10,000 no matter what. If she just wrote a check, her tax bill was still pretty high. But by donating that exact same amount using a QCD from her IRA, she lowered her taxable income and saved $1,700 in taxes. Same donation, just a much smarter way to do it.
Our final strategy is all about playing the long game. It's called Roth conversions. This is where you strategically move money from your pre-tax traditional IRA over to a post-tax Roth IRA. Now, you do have to pay taxes on the money you convert, but you do it now, ideally in a year when your income is lower. So why would you do that? to avoid paying much, much higher taxes later on.
I love this quote because it just says it all. You're paying taxes on the seed, the smaller amount now, so that all the future growth, the harvest, is completely tax-free. This is so important because it shrinks your future required minimum distributions. Those are the forced withdrawals the government makes you take later. Smaller R&Ds mean a smaller tax bill, plus you've built yourself a beautiful bucket of tax-free money you can dip into whenever you want.
Okay, knowing what to do is half the battle. Now let's talk about the other half, avoiding the critical mistakes that can wreck all of your careful planning. So let me ask you a question. What do you think happens if you start collecting your pension while living in a high-tax state, and then you decide to move to a place like Florida or Texas?
Here is the brutal, honest truth. Your old state can, and often will, claim the right to tax your pension payments forever, even though you don't live there anymore. This one single timing mistake can cost you tens or even hundreds of thousands of dollars. It's a huge trap.
Okay, I know that was a ton of information, so how do you actually put it all together and make it work for you? Let's build a simple, clear action plan you can start using today.
Here's your roadmap. First, you just got to analyze your whole retirement income picture so you know what money is coming in and when. Second, you run the numbers, model a few different scenarios to see which strategies save you the most. And from there, it's all about taking action, actually making the move, calling your IRA custodian to set up those QCDs, or mapping out a smart Roth conversion schedule over a few years.
And to make it even easier, here's a checklist of things you can do this week. Seriously. First, map out that income timeline. Then, play around with an online tool and model at least 3 different tax scenarios. Start looking into your state residency options. If you're over 70 and a half, make that call about QCDs. And finally, think about scheduling a chat with a tax pro. Taking these small steps right now can have a massive impact down the road.
So I'm going to leave you with this one question to think about. Over the next 20 or 30 years of your retirement, how much of that pension you worked so hard for will you actually get to keep and enjoy? And how much are you just going to give away? The good news is, after today, you have the strategies to decide that for yourself.